Amazon just beat earnings by 216%, and roughly 85% of that beat never touched the business. Three things today. One, how a 216% beat shrinks to 12% on the second page. Two, the number that made me check the filing twice. $161 billion of operating cash and negative free cash flow anyway. And three, whether $271 is an entry price or an exit price. Get this one wrong and you are funding somebody else's experiment. Get it right and you understand the whole AI trade. Welcome back to Wall Street Holic, where we cut through the market noise and deliver sharp, data-driven insights without the hype, bias, or distractions. Just clear facts, deep research, and actionable analysis to help you make smarter investment decisions. Every insight is backed by real data, and if you want to dive even deeper, you can download the full research-packed report using the link in the description below. Pricing is $271.18 as of the 31st of July, 2026, up 15.15% in a single session from a $235.50 close. This is research and education, not personalized financial advice. 7 numbers on the next slide decide whether that jump was insight or FOMO. The conclusion in 5 numbers. Price stands at $271.18. Intrinsic value at $282. Our confidence in the price is medium, and a probability-weighted expected value after all valuation metrics considered is $291, 7.2% above the latest price. Probability weighting means multiplying each future calculation by its odds and adding them up to conclude probabilities of a bear price at $198 at 30%, a base price of $300 with a 45% chance, and a bull at $385 at 25%. That $291 looked far more exciting yesterday morning when this stock was $35 cheaper. $5.75 of earnings against $1.82 expected, except $53.4 billion of that, 2/3 of pre-tax income, was a non-cash revaluation of Amazon's Anthropic stake. Strip it out, and core earnings were $2.04 a share, a 12% beat, real but ordinary. A price-to-earnings ratio is what you pay for $1 of profit. On the headline, 21.8 times. On what the business actually earns, 38.2. Nearly 40 times earnings is a premium price, so the business underneath had better be exceptional. $775.7 billion of revenue, 1.6 million employees, and a profit engine hiding in plain sight. AWS is 21% of sales and 58% of operating profit. The margins explain it. 36.8% at AWS, 7.4% in North American retail, 3.1% internationally. The most important takeaway is that 1/5 of revenue carries 3/5 of profit. That one pillar is the story. Online stores did $70.4 billion of revenue, growing 15%, but the two that count are AWS at $42.2 billion, up 37%, and advertising at $19.8 billion, up 26%, under 1/3 of revenue between them, and the overwhelming majority of incremental profit. One of those two just accelerated for a 5th straight quarter, and every pillar of the business grew. AWS grew 36.7%, its fastest in 18 quarters, on a $169 billion run rate, and expanded margin 650 basis points to 39.4% while adding capacity and utilization. Then, the poster number is the contracted backlog of $496 billion, up from $244 billion at year-end 2025. This is signed, not hoped. Capacity is sold before it is built. Sounds like free money, but we should not forget what the building costs. A moat is whatever stops a rival copying you profitably, which is why investors pay up for one. Amazon's has 3, its own silicon, with 98% of the top 1,000 cloud customers on Graviton, Bedrock hosting every frontier model so Amazon need never pick the winner, and delivery density. 3 moats in AI and a satellite constellation with Leo is a lovely story, exceptionally when it shows up in the accounts. Revenue hit $200.6 billion and operating income $27.5 billion, up 43%, twice the pace of sales. Margin bottomed at 9.7% in late 2025 and has climbed to a new record of 13.7%, all while capex accelerated. The third quarter guide steps down to $22.5 to $26.5 billion, mostly because of Prime Day timing. Amazon hit record margins, profit compounding twice as fast as sales, but the cash flow statement disagrees. Operating cash flow is $161.4 billion, up 33%. Free cash flow is negative $7.6 billion against positive $18.2 billion a year ago. Free cash flow is what is left once all the bills are paid and the assets maintained. Basically, it's like your salary after rent, bills, and a new kitchen. The gap, $220 billion of capex against $75 billion of depreciation, a bet that AI demand is worth funding early and now for the future. Every dollar of that bet has to come from somewhere, so let's check the balance sheet. Amazon still has a fortress balance sheet, $123 billion in cash and securities, net debt of $100.2 billion, debt to equity of 23.4%. But watch the direction. Long-term debt nearly doubled in 6 months as Amazon raised $67 billion to part fund the AI build-out. One line in these accounts jumped $161 billion in 6 months, and almost no narrative captures it. This is why here at Wall Street Holic, we deal with the facts and the data and explain in clear numbers the full story. Don't forget to subscribe to our Substack for even more in-depth analysis and easy-to-understand information. Amazon put roughly $13 billion of cash into Anthropic. The stake is now carried at about $188 billion, an implied 19.5% of a company valued at $965 billion, worth around $14 per Amazon share after tax. Anthropic has now filed for an IPO, targeting an October listing. That listing turns an internal estimate into a public price, in whichever direction it goes. Return on invested capital is what a company earns on every dollar it puts to work. Cost of capital is what those dollars cost. Earn more than you pay and you create value. Earn less than you pay and you destroy value. Amazon earns 17% on capital already in the ground against a 9.75% cost. But on $656 billion of new money, just 11.6%, a spread of 190 basis points. It's a nice cushion until something goes slightly wrong, which is why we have a confidence level of medium. The multiples, 38.2 times trailing core earnings after the Anthropic revaluation is stripped out, 34.7 times this year, 28.3 next. A PEG ratio of 1.52, fair, not cheap. Enterprise value to EBITDA of 17.9 against Microsoft's 17.2 and Meta's 14.2. And a free cash flow yield of minus 0.26%, with no dividend and no buyback. Paying a premium for zero cash back only works if the market is enormous. The critical part to consider is that Amazon's pillars of business, retail, advertising, data centers, chips, the AI build-out, and soon satellite constellations to provide connectivity, are a much bigger diversification than Microsoft and Meta. The market opportunity for Amazon is large across all its business pillars. Cloud and AI infrastructure, roughly $1.4 trillion by 2030, with AWS about 12% penetrated. E-commerce outside China, $4 trillion. Amazon at mid-teens share. Advertising, $800 billion. Amazon under 10%, but compounding at 26%. Treat all three as ceilings. A total addressable market is the size of the pie, not the complete share. The pies are enormous. The better question is who else is standing in it. Rivalry is high, and honestly so. Azure grew 43% this quarter, and Google Cloud 82%, against AWS at 37%. Supplier power is high too. Memory is the binding constraint, and Amazon named memory costs when it raised capex by $20 billion. This means new entrants might be locked out, and our AI infrastructure builders are already decided. When admission to the party costs $200 billion a year, the build is not a cost. It is the moat. The 10-year yield sits at 4.65%, the 30-year at a 19-year high, and 3 Fed members voted to hike. We are modeling the Amazon cost of capital at 9.75%, 5.1% higher than the 10-year risk-free rate. The reason being 78% of the modeled value is cash arriving years from now, and long-duration assets justify a higher rate when the end is years from now. But some comfort in this is that big tech has already derated. Rates you can measure. The harder question is whether you trust the people spending the money. Single share class, insiders around 9.7%, institutions 72%. There is no dividend, no buyback, and a share count rising rather than falling. Against that, the Anthropic call, which turned $13 billion into $188 billion. Simply put, shareholders are funding $220 billion a year on management's read of future demand, with the backlog as the only hard evidence. Wall Street has just voted on that trust within the last 24 hours. 11 target revisions in a day, everyone upward, from JP Morgan at $365 to UBS at $305. But consensus now implies about 15% upside. Yesterday, from $235.50, the same targets implied nearly 30%. The move did not create the upside, it consumed it. Consensus has told you the good news. The risk list is where the argument lives. Considering the risk of a company is critical, rated critical, AI demand normalizes while $220 billion a year of assets depreciates on a 5-year schedule. 30% likely, with the $496 billion backlog as the mitigant, most likely at 40%. Memory and power inflation, where rising costs buy the same capacity for more. Then multiple compression at 35% and an Anthropic write-down. Everyone collapses into a single question: what is this business actually worth? Our first method of valuation is a discounted cash flow model. It asks what all the cash a business will ever produce is worth today, because $1 in 2035 is not the same as $1 now. Think of a mortgage run backwards. What a stream of future payments is worth as a lump sum by the time the mortgage is paid off. 10 years of Amazon's cash, charged for the capex, gives $174. 36% below the price. Before anyone hits sell, 78% of that answer is a guess about 2036. Push the assumptions around, and the model returns $137 to $233 across the whole grid, never $271. Run it backwards, and a reverse discounted cash flow asks what the market must already assume. To justify today's price, Amazon needs a 23.6% operating margin. Its record, set this quarter, is 13.7%. Yes, for Amazon to reach the current valuation, it needs to improve operating margins every year for the next decade. One method is shouting sell, and the honest response is to weigh it, not bury it. Our second method of valuation is against peers. Amazon is the expensive one on earnings, 34.7 times forward against Microsoft's 23.1 and Meta's 18.3, and the cheap one on EBITDA at 15.3 times because depreciation flatters that measure. Apply 30 times next year's core earnings, and you get a price of $302. 15.5 times EBITDA gives a valuation of $349. All of those price Amazon as one company, when the argument is it is two. Our final method of valuation is what this fixes. Let's take the key pillars and value them individually. We value AWS on its own economics, $215 billion of revenue at 28 times EBIT, and AWS alone is worth $221 a share. Retail and advertising at 18 times add $92, the Anthropic stake $14, and net debt we take away $9. That lands at $317. 4 methods, a $175 spread. So how do you get to one number? Our methodology weighs them. Sum of the parts takes 35%, the only method pricing the entire engine separately. The discounted cash flow still takes 25%, inconvenient answer and all. Peer earnings, 25%. EBITDA, 15%. Ultimately, we get a fair value blend of $282, 4% above the current price. The business clearly demonstrated an improvement today, and the price moved further. Fair value is one snapshot, and the future rarely arrives as a single tidy number. 3 future markets. The bear is at $198, 30% likely, Demand normalizes, the multiple compresses, Anthropic prices below its mark. The base price is at $300 at 45%. AWS holds low 30s growth, cash flow turns positive in 2029. But the bull price is at $385 at 25%. The build proves undersized, and the market pays 36 times. This gives us a weighted price of $291. A spread that wide means both sides get a hearing, and the optimists are going first. The bull case is disarmingly simple. The capacity is already sold. Backlog doubled to $496 billion in 6 months, and management says even $220 billion will not meet 2026 demand, which likely means an increase in capex. Amazon owns its cost curve through its own chips, monetizes AI through Bedrock without winning the model race, and has a $76 billion ad engine gaining momentum. A powerful case. So here is the one that needs nothing dramatic at all. The bear case needs no disaster, just arithmetic. The discounted cash flow says $174 on Amazon's own capex guidance. The earnings move the stock 15% with a 12% operating beat once the accounting comes out. Free cash flow stays negative until 2029, and rivals are growing faster off smaller bases. Both cases are credible, which makes the chart worth a look before deciding on timing. Today is a breakaway gap on 53 million shares, double the average volume, and gaps on that volume do not fill quickly. Price is above the 20, 50, 100 and 200-day averages at once, with RSY at 63.9, so not overbought. The catch, this is at 91% of the 52-week range. Strong chart, stretched entry, which makes the next question less about the stock than your judgment. This suits a 5-year holder who can sit through 3 years of negative free cash flow and anyone happy to be assigned shares at a discount. It does not suit an investor needing income, no dividend, no buyback. And if the discounted cash flow is your primary tool, your own process says $174. Matching a stock to your situation and risk profile matters more than whether it is a good company. Dates for the diary. September, the Fed meets, with 3 members already voting to hike. October, Anthropic lists, a direct mark on 5% of Amazon's share price. Then, the 29th of October, estimated third quarter earnings. And the first test of that guide down is one to keep an eye on. Dated catalysts matter, because that is when the market must reprice. Dates only help if you know what to do with them. The verdict is a slight buy. Expected value $291, 7.2% above the price, and our confidence is medium on the valuation. Own it, do not chase it. Accumulate toward $246 to $262. Implied volatility is the market's forecast of how far a stock moves, priced into the option. Here it is 31.8%, below the 36.5% delivered, because the event has passed. That one fact changes which options trade makes sense today. The headline trade is a cash-secured put. You agree to buy shares at a set price, hold the cash ready, and get paid for the promise. Selling the September $250 put sets a basis 11% below fair value, and assignment is the intention, not the accident. A January 2028 $260 call adds long-dated upside. Covered calls are skipped because capping a right-skewed payoff forfeits the part that pays. Options can lose fast, so tread cautiously. Structure is half of it. The other half is the 3 prices that govern everything here. Our floor price for Amazon is $124, the no-brainer price, where you pay nothing for growth, nothing for advertising leverage, nothing for the expected outcome. But $282 is intrinsic value with all data considered. What the evidence says it is worth today. And finally, $385 is the high case, needing AWS above 35% growth and margins toward 15%. Fairly priced is not the same as unattractive. The difference is your time horizon. The idea is to buy low and sell high, and the current price is fairly valued, not cheap. Long-term, positive. The backlog and 17% returns on installed capital make this a compounder, with the expected continuation of growth and momentum in AI. Medium term, neutral to constructive. The next 4 quarters are a run of tests and the Wall Street holic theory. However, short term, be cautious. The least favorable entry in the cycle is likely now. We believe the fundamentals score 8 out of 10 with a technical rating of 7. Take one line from all this. The business got better today and the price got better faster. Across the Wall Street holic coverage, Amazon's 7.2% expected upside is the second narrowest on the board. Microsoft sits at 18.8%, Micron at 20.5%, and Nvidia leads at 37%. None of that makes Amazon a bad holding, just not the loudest opportunity in the market right now. Which brings us back to where we started. A remarkable business at a price that has already caught up. So in summary, Amazon is building the second largest AI compute estate on Earth and owns the silicon underneath it, earning 17% on capital already in the ground against a 9.75% cost. But the marginal dollar earns 11.6%. Free cash flow stays negative until 2029, and today's 15% move has taken the price up to roughly what the business is worth. Fairly valued, high variance, accumulate on weakness. And notice what you just watched. Research that gave its own worst answer, a $174 discounted cash flow, a full 25% weight. At Wall Street Holic, we ignore the hype and follow the same disciplined, data-driven process, being transparent about what we know, what we don't, and where the evidence leads. Don't forget to download your copy from Substack with the full research in this video using the link in the description below. If you want to cut through the market noise, hit subscribe, give the video a like, and share it with others to benefit. Leave your comments below. See you in the next video.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.